So I can't wait to talk about what we're going to get into today. Got a little bit of a cold, so there's the chance I might be coughing a little bit on the show today. We're going to carve out these little itty bitty shows, minis we'll call them, and we're going to focus on dividends. Every time we do a dividend show, more and more of our listeners, watchers, whatever, you know, they love it. Yep. So we're going to have a little segment that we're going to be doing
probably
all the
because
time.
we love it so much.
We get a little fired up. So today we're going to talk about the power of dividend growth very, very quickly. So let's just dive right in. What the heck does it mean when you hear somebody say dividend growth?
Yep. So really think about it as like that's whenever a company has this regular routine of increasing the amount that they pay out in their dividend.
Yeah.
So it's not just, hey, they pay $2 every year. It's like, no, they pay $2 and then next year they might pay $2.25 and then $2.50 and then $2.75.
And there's some companies out there that are super passionate about their dividend and when they increase it. And you saw that, I saw that firsthand, in 2020. 2020, year the world shut down. It was a scary little time. I was afraid to go outside at some point. I never had more gloves and masks on in my life, right?
Remember wiping down your groceries?
Oh, man. So, during that time, oil and gas industry is known for paying dividends. And, you saw the world shut down. People were working from their home. It was crazy. And one of the major industries that got absolutely crushed was oil and gas.
Yep.
And what happened in 2020? They all paid their dividend.
Yes.
Not only that, you would see the dividends being raised by 1 penny.
Yep. Exxon was one of those. And you look at 2 years of a penny.
You look at why in the world did they raise it by a penny? Because they didn't want to break their streak.
Yep.
Because when you're talking about companies that have dividend growth, this is really, really important. Even to the point where the CEOs were coming out saying, hey, we'll lay off, we'll cut benefits, we'll do this, we'll do that. But our investors are the most important. They're our number one priority. So we're going to do everything we can internally to absorb the cost of this pandemic. Yep. So externally, our investors are held up high. As an investor, that's like music to my ears.
Yeah.
So let's give some examples of companies that have paid their dividend forever. So a couple of notables are Coca-Cola, Johnson & Johnson, and 3M. Now, right out of the gate, not endorsing anything here, just giving some factual information. So Coca-Cola, Johnson & Johnson, 3M have all been paying and raising their dividends for the past 60 years. So that means 60 straight years.
And the great thing that I love to talk to our clients about, and even some of our other advisors, think about what's happened in the world over the past 60 years.
I know.
And they've still, through all of that, the ups, downs, sideways, different administrations.
Yep.
Just had a guy at the gym this morning. He's like, you ready for your clients to go, whichever way? And I'm like, for the election?
Yep.
I'm like, man, we're just strong and steady. We've got it.
So another one is Procter Gamble. That's 65 years. Now, we could go on and on about companies that have been paying and raising their dividends. But I think what's more important is really the effect of reinvesting versus paying out. So I had a client years ago who didn't really get that. A sophisticated investor, and he's like, I love the sound of the dividend. So I want to invest, a bunch of money, but I want you to take the dividends and pay it into this account over here. So we did it for about 6 months, 8 months. And then he comes back to me. He's like, this just isn't working. I'm not making any money. My response to him, although it wasn't probably the greatest, was like, well, I don't think you quite understand the power of dividend growth investing. And he's like, how could you make a statement like that? Because this is a very sophisticated individual. And I'm like, well, first of all, you're not reinvesting their dividends. You're sending it to some checking account that you probably don't even know where it's going because he's got lots and lots of money. And then you're just watching it. You just turned it into a growth stock. And he's like, I understand what I'm doing. It's just not working. You're not giving me good advice. And I'm like, then fire me. Apparently you know more. Why did you even start it? So we ended that relationship on what I would call bad understanding of a really, really good investment opportunity. And it wasn't that I picked the most amazing or didn't pick the most amazing stock, is that he's not using it as intended.
He's missing out on the dividend reinvestment plan.
Correct.
Drip.
Well, and then, so let's talk about that really quick. So we're going to talk about the reinvestment versus the non-reinvestment on the same stock. So the first example we're going to talk about is Duke Energy. Okay, Duke Energy is a local company right here to Charlotte. They're headquartered right uptown. So we're going to invest $10,000. We're going to go back 20 years. All right. So 20 years ago, we invested $10,000. If we did not reinvest their dividend, that $10,000 over a 20-year period would have turned into $52,840.
Not bad.
Pretty awesome.
Not bad.
So you have $10,000 in 20 years that turned to 52. I'm pretty happy. If you reinvested that money, the same stock, okay, the same $10,000 starting value 20 years ago, that value today is $89,519, $37,000 more because of the difference of paying out the dividends versus reinvesting. So you've got this company that's been paying dividend consistently increasing its dividend. The price has been doing this. So I had that client's like, hey, the price going up, price going down. I've been in this for 9 months. You're not doing anything that I can't do by myself. I'm like, sure. Okay. But he missed the value because he's taking that dividend and he's shooting it somewhere else. In this example, that's $37,000 difference. If he would have done over a 30-year period, he would have missed out on $37,000. Either way, they weren't spending it.
Right.
All you're doing here is reinvesting it. Here's another example. Altria, another company. Same $10,000 investment, okay, 20 years ago. Everything's the same. That $10,000 only turned into $32,000. Not very good, right? If you reinvested that dividend over the same 10-year or 20-year period, what did that jump to?
$132,000.
So
that's insane.
The difference here on reinvestment is $100,000. Okay, and this is why I wanted to use this example, because this is one of the if you're saying, hey, he cherry picked that. Yes, I did.
Yeah.
Okay, and I did it because I wanted to show you an extreme example, because this stock had massive volatility, and during that massive volatility, it's raised its dividend, and because it had these big peaks and troughs, you were able to really compound the effect of dividend investing over the last 20 years, which gave an investor an extra $100,000. Does anybody else want $100,000?
Yes.
That's pretty huge. 32 to 132 is a massive difference. And this shows you the effect of wild volatility and reinvestment in spite of it. Because you have a stock that literally was massive. If you go look at their chart, it's crazy.
Yep.
But they consistently paid their dividend. They consistently increased it. And you took advantages of massive, buying low type of opportunity.
Well, you're just continuing to just steadily buy each year, each quarter, really, every time they're paying that dividend.
This is that snowball effect.
Yep.
So when you're at the top of the mountain, and this is probably, if you're that investor out there that's like, it's not fast enough for me. It's when you start, you build a snowball, you pack up the snow and you do like this, and you start rolling it. And in the beginning of the top of the hill, it goes from this big to this big, and seems like it takes you forever, right? And then once it starts picking up steam down the hill, now all of a sudden there's this point where it's like, oh my gosh, I can only move it a couple more times because I can't control it anymore. And that's what happens with dividends. Where in the early years, 5-7 years, it just doesn't feel like much, although it can be really awesome. Yep. But that power of dividend growth really expands the longer that you're in it. So I liken that between microwave investments and crockpot investments. Microwave investments, what we all love. That swing of the bat, and in one swing, we can hit 4 runs home. That grand slam effect. I want it right now. Crockpot, not so much. It's that boring leadoff hitter that always gets on first.
Yeah.
The cool thing here is when you give dividends time and then you pick the right ones, magic can happen.
Well, it's think about it, 5% on 1,000. Okay, now we're talking 5% on 100,000. Now it's that same snowball where it's really growing. And
so lastly, really quick, let's talk about the real benefits of dividend growth investing. And this is where stability and reliability really come into play. When you have a volatile market And the markets can be nuts and they can turn on a dime.
Yep.
And statistics state that if you get out of the market on, I think it's 5 days a year,
Yep.
5 of the best growth days a year, you lose over 50% of the return. So if you're that emotional investor and is like, I'm in, I'm out, I'm in, I'm out, and then you just happen to miss 5 of those days, you lose 50% of the total return.
Yep.
Which is nuts. The biggest reason they lose and they get emotional is there's no real attachment to staying in when things get rough. Well, that is changed with dividend investing. When you have a dividend stock that's paying you, literally, like if I came up to you and I was like, hey, does this sound too good to be true? Like there's companies out there that will pay you cash to hold their investment. Would you believe that? If I said, hey, this company out here will literally pay you, I don't know, $4 for every share that you purchase of their stock every year, as long as you hold it. And next year, they'll pay you a little bit more. It might be $4.05, $4.08.
What's the catch?
Yeah, what's the catch? Like, why would somebody pay me to hold their stock? Well, that's a dividend. It's been around for hundreds of years.
Because they're using your money
to grow their company.
You're getting profit share is essentially what's happening.
So this is real, and I'm just framing it a little bit different. But the difference between a growth stock and a dividend stock is a growth stock, when times get rough, there's nothing holding me to the fire. You know, like I don't have to stay here. I'm just going to lose my shirt. With the dividend, it's like, oh, I'm about to embark on an opportunity where I can buy lower.
Yep. Because
the stock is up here, and now the stock's going to drop here, and now that dividend is going to get bought back in at a cheaper value. That's the biggest difference, why value continues to outperform growth over time. And that time is 15 years. If you go 0 to 14 years, in any given 0 to 14 year, you can see value and or growth outperform. Once you get past that 15-year mark, at the 15th year, you'll never find a time where value has underperformed growth. That means every single time, 100%. I'm not in the guarantee game. I'm not going to say guarantee.
Yep.
But statistically, when you look back at the facts, you're not going to find a period in time, my dyslexia fired there, where you're going to see growth outperform value, those boring old dividend stocks over a 15-year period. Okay, last thing, takeaways. Yep. What do you got?
Most of the time, it's not flashy up front, but whenever you allow time in this compounding effect, we're seeing it every single day, every review we're doing with our clients who've been here with us, really kind of this over 5-year mark, even for our clients, you can see this like really robust growth that's happening for them.
I would say that a little bit different, but I'm going to say the same thing. Yeah. A couple months ago, I was at school with my oldest at Stanford University, and we were there for a parent weekend and met this other lady who happened to be a financial advisor. And we talked about our businesses, and she does the same thing I do. And she asked me, what our strategy is. I said, dividend investing. And she goes, and she was kind of like, okay, expecting me to say like a lot more. I was like, no, just dividends. Like that's what we focus on. And she goes, so how's that working out these days? I know back in time it used to be great, but with so much sophistication and all these other strategies, it just can't keep up anymore. And I kind of stepped back, and my son is really good friends with her son, so I didn't want to be ignorant or anything like that. But I was like, you do realize that time plus dividend equals success. Like no other investment out there has been able to beat dividend investing over a shorter period of time. Yes. Longer period of time. No. Even in today's environment, yeah, 15 years is the magic number. Who wants to live more than 15 years? I don't know anybody. It's like, hey, just make me money in 14 years. I'm good. Right. Like at the end of the day, people want to live longer and they want to enjoy life better, more fruitful, longer on. If that's the case, then dividend investing is all you need to know. Yes, there are other things in a shorter period of time, but over time, dividend is number one.
Love it.
We're good.
Yep.